Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Sayuri Shirai, who's professor of economics at Keio University. Professor, thank you very much for joining us. So to that question, are conditions falling into place for another rate hike this year, and perhaps not today, but coming?
Well, that's very uncertain because if you look at the Japanese economies, the domestic demand is not falling, but it's very sluggish. You know, the real GDP level just recovered the first quarter of 2019, pre-COVID-19 pandemic. So you can see how, slowly the Japanese economy is growing and it remains very sluggish. So I don't really see why Bank of Japan is able to, have another rate hike. Because in July, there was an issue of the excessively cheap Japanese yen. Yen was moving around 160 until second week of July. But now yen is around 142. It's much better, but still very depreciated. So, but at the same time, because the Japanese stock prices are associated with yen's depreciation, so now Japanese stock prices are much lower than before. So I think BOJ will be a bit careful in terms of raising interest rates this year.
So the question is whether that sluggish demand is in any way connected to higher prices. I mean, Japan has been in a inflationary period for some time now. And today we got the reading on core consumer prices for the month of August. Yes, it's in line with estimates, but that rate, annual rate, is 2.8%.
Yes. So if we look at this morning, August inflation rate, headline is 3.0%. And actually 60% of this inflation comes from food and energy. So you see, this is really cost push. So it's kind of hurting consumers' budget. So that's why real consumption remained very sluggish and much lower than the, 1-2 years before. So, it's really cost push. So, in that sense, just raising domestic demand, I don't really see a BOJ will be rushed to raise interest rate.
So, Professor, in terms of that balance, in the mindset of policymakers and in the mindset of the public, is it still deflation that worries them, or is it starting to be inflation now?
Okay, so from consumers' point of view, public point of view, everybody's seeing food are much higher, so people feel inflation. I think nobody is thinking that we are deflation, but the government is still not declared that Japanese economy is out of deflation because I think it's basically cost push. And if we look at the weak domestic demand, we don't really see a demand-driven inflation yet. And the BOJ also want to have a more virtuous, price income cycle. So that hasn't been materialized yet. So it's for consumers, it's inflation. But for policymakers, it's not really inflation they want, the desirable inflation they want to achieve.
So if there is no change in policy, what should the communication be from Governor Ueda?
Yeah, one difficulty is that although yen appreciated to 142, much better than 160, but there are still chances that yen may depreciate again. Depending on what will happen to U.S. presidency, possible U.S. rate cut, there's a lot of uncertainty. So yen can depreciate again. So in that sense, I think Governor Ueda will be very, very careful. And maybe he will still hint the possibility of raising interest rate. I think he may be concerned about the resurgence of excessively cheap yen.
Are we in the midst of a positive wage price cycle?
Okay, so this year it was very good, very high successful wage negotiation settlement. So we actually see wages started to pick up. So it's much higher than, inflation. So real wage is actually growing. But at this moment, most of this wage hike come from bonuses. So it's temporarily. So it's not really like a permanent based wage growth yet. So a lot of consumers have not felt that their income and wages are growing. So I think we still have to see whether companies are able to continue to pay more regular type wages for next year and 2 years after. But the Japanese economy is quite sluggish, so they really have to make efforts to improve their productivity growth.
I know you're a professor of economics, but I'm going to ask you to weigh in on politics just a bit here because we have the elections approaching for the leadership of the Democratic or the Liberal Democratic Party.
Yes.
How do you think the economy is going to factor into the election?
So LDP, there are some differences. Some people pay more attention to the, fiscal consolidation. We have huge debt, but I think, but most of the people they still want to support Japanese economy, and so if possible, occasionally they want to do some income support for low-income people. But because of the budgetary constraint, they cannot really do an extremely expansionary fiscal, policy. So I think in terms of monetary policy, they will support current policy. So I don't really see a big changes, I don't really see a big, divergent view in terms of where Japanese economy should head among this potential 9 candidate.
Well, and I suppose we should ask you whether or not it's possible if Sanae Takaichi, a woman, can somehow wrest the position of prime minister. Is it time for Japan?
She did very, very successfully last time, and she's quite well figured. But I think my understanding is she's a person who likes to really, energize Japanese economy. So I think she support like a greater fiscal stimulus, and so. If she's selected, maybe she will continue to provide more fiscal support and then maybe monetary easing. I think she will stress. But I don't know. There are other more independent type of candidate who are also very popular. And then they may have a somewhat different view.
One of the things that we look at when we talk about the interest rates in Japan are how well the banks are functioning right now. Do you have a view on that, Professor? How well are the big banks in Japan performing these days?
I think big banks are doing well, and it's not a lot, but credit, loans are growing at 2 to 3%, pace. So, and Japanese banks are doing well, especially big one, because they are, have a lot of, businesses globally and also Asia and United States. So they are very diversified. So I think, mega banks, they are doing quite well.
All right. Thanks so much, Professor, for joining us here live on the program. It's always fun to talk to you. Sayuri Shirai, who is Professor of Economics at Keio University. Joining us on the program is Garfield Reynolds, Bloomberg's chief rates correspondent here in Asia. Garfield, great to have you with us. So historically, we know that equity markets have done pretty well when you have periods where the Fed is cutting interest rates, as long as the economy is not in recession. So that's the big point. Does it look like the U.S. economy, or indeed the global economy, is anywhere near recession?
Well, the U.S. economy still looks to be pretty strong. We had initial jobs claims coming in lower than expected. That's a good sign. And in fact, the Atlanta Fed's GDP Nowcaster, as it's called, that's seeing GDP coming in at just under 3%. So none of that says that the U.S. economy is in trouble at all. Gels with Powell's comments that the economy is doing just fine, and that helps to explain why equities, after an initial wobble on the actual day of the decision, they've ultimately climbed to yet another record. That seems to make sense until and unless we get a downturn. Non-farm payrolls would be the next strong data point risk that you would have on that front. On the broader front, the U.S. lowering interest rates does help the outlook for the world economy. There are some concerns in a number of areas that growth is slowing down. The biggest worry is China, the Chinese economy, which is the world's second largest, and it's in a very serious and sustained funk. There's a lot of hope when you look at what went on with the yuan yesterday, when you look at what went on with Chinese stocks, that the Fed cutting by 50 basis points will clear the way for China to finally take some more decisive action to try and get that economy turning around, which is something that arguably is in the global economy's interest.
That's an interesting way of characterizing the Chinese economy, sustained funk. I haven't heard that before. Maybe we can talk about the BOJ. Brian mentioned the fact that no one really is expecting a move today, maybe next month at the October meeting. It's interesting that the October core consumer price index reading for Japan, this is for the month of August, up at an annual rate of 2.8%. That seems pretty hot. I know it's in line with estimates. Could you make the case that the BOJ really could make a move and get away with it?
I think they would struggle to get away with it. As in that would set off some fairly serious market turmoil that I'm not sure they have the appetite for. It also wouldn't really gel with Ueda's playbook. Now, he's only been BOJ governor for a while, so we're all feeling our way there with it. But he is tending to try and be methodical. His indications when they raised rates back in July was that they do expect to raise rates again if the economy develops as they've been forecasting. It has done so, but the main risk that most people are seeing going into this BOJ meeting is that he opens the door to a rate hike, next month, in October, rather than he would actually hike at this one. Now, the one caveat there is that the BOJ, both under Ueda and under his predecessor, Kuroda, has shown a capacity to surprise markets, so you wouldn't rule it out. The bigger risk that people are seeing, though, going into this meeting is that he takes a more hawkish stance, even as rates are left alone this time round.
One of the interesting aspects of the Fed move this week is that long-end rates have actually risen 2 days in a row now. Mortgage rates ticked up a little bit, and that has some implications for both Japan and China. But let's take a closer look at that. I know you watch rates pretty closely. Is that tied to a stronger economy or maybe inflation fears?
It's far more tied to a stronger economy. There are some lingering inflation concerns, but it's about that economic resilience that's being shown. And tied to that is the way that the Fed, although they cut 50 basis points, which was more than was priced in, it was seen as being a good chance, but it wasn't fully priced in. So it was a bigger than expected rate cut, supposedly. However, they pushed back pretty strongly against what the market is pricing for the coming meetings. So markets are pricing for 75 basis points over the last two meetings of this year, and then another 50 basis points in the first meeting of next year. The Fed's making it pretty clear. It thinks, two 25 basis point cuts this year is what should be on the table, and then that they would take a look at it and that they would take a fairly measured pace going through 2025. So that puts the Fed and the bond markets at odds. That helps to explain, why yields are climbing on treasuries. And in particular, at the long end, there is this lingering concern that once we get past the elections and into next year, whoever is in the White House is going to keep on boosting spending. There's concerns about the long-term sustainability of the U.S.'s debt path. And that's the sort of thing that shows up in higher long-end yields.
Okay.
So do you think that Powell can stick a soft landing, and maybe that's what the bond market is telling us a little bit at the long end?
At the long end, the bond market is also buying into the potential for a soft landing. And it'll be interesting to see how it goes. There's been a lot of bullishness in the bond market on the idea that they won't be able to stick a soft landing. And the Fed actually has very, very rarely stuck a soft landing. It's far more often the case, in fact, that it starts out with that aim and with a measured pace of rate cuts, but then things go very badly south, as they did in the early 2000s and as they did in 2007, 2008, and the quantum of rate cuts in those events, ended up being very steep at, after, sort of a couple of cuts, and then bang, the bazookas had to come out.
Yeah. Okay, final note. Mercedes-Benz in China, a little bit surprised at the lines that they've delivered here, talking about rapid deterioration of business in China. What are the implications of that?
Well, we were talking at the opening of the program about how the China's economy really needs some serious help from the authorities, and this is another. It's showing the intractable nature of the consumer downturn there.
Yeah, it certainly is. And it really does kind of elevate the pressure on some of these foreign car makers there. Anyway, Garfield, thank you very much for joining us. Garfield Reynolds, Bloomberg Chief Rates Correspondent. Joining us now in our studios is John Lieber, Managing Director of Eurasia Group's U.S. practice, to talk a little bit more about U.S.-China relations and the U.S. elections coming up. John, thank you for coming in. So China is pretty absorbed with its stumbling economy here at the moment. The U.S. is pretty well absorbed with the run-up to the elections, and the Middle East is semi on fire. Have U.S.-China relations kind of taken a back seat at the moment?
They've taken a back seat, but it's probably only a temporary reprieve. This is a huge issue in the election. It's not really a political issue that the two candidates are trying to define themselves around. But after the election, there's a potential for a big shift in U.S. policy. Because if Trump wins, what you're going to get are probably disruptive levels of tariffs, along with expanding export controls and more pressure on U.S. allies around the region to continue to squeeze the Chinese economy. So that's a bad outlook that probably slows growth across the Asia-Pacific and is a top concern for a lot of the U.S. trading partners in the region.
So, John, take it from the other side now. What if Kamala Harris were to win the presidency?
The outlook's not great for U.S.-China relations, no matter who the president is. But Harris is we think she continues the Biden policy of managed decline in this relationship, but it's still decline. It's still the fact that there's probably going to be less U.S.-China trade going forward, more efforts to get Chinese goods out of U.S. supply chains, and further efforts to prevent U.S. investors from getting into China, especially in sensitive technology areas like semiconductor and AI.
It's kind of a dark picture that you paint no matter who wins the presidency. Are you expecting that this will be very disruptive to the global economy, not just the regional economy in China?
It could be. It probably depends on the level of restrictions that you see coming from the U.S. going forward. And of course, the choices made by non-aligned countries who are kind of caught in the middle here. And those are countries that continue to want to do business with both the United States and China, and will probably find a way to do so no matter what the U.S. does.
So how do you assess the situation right now that President Xi finds himself in? A stagnant economy, a deflation that's been going on persistently, and you've got to imagine that people are not happy with the performance of the overall economy. What's at stake for Xi?
Yeah, that's exactly right. And I think that what you're hearing from people who have recently left China is sort of a deep dissatisfaction, both among the population, but also at the elite level, who see that President Xi's policies have somewhat reversed the outsized economic gains that China's made over the last 2 decades. And it's a real challenge. And we think that probably stimulus is coming, but maybe not till next year, because China's got big concerns about its debt bubbles and moral hazard associated with the additional stimulus. But at some point, on the current trajectory, they're going to have no choice but to bail out the Chinese economy.
On the U.S. elections themselves, how do you see this moving over the next couple of months? We're getting down to the crunch period here. It seemed like former President Trump was in the pole position for a while. Now it almost seems like Kamala Harris has taken that pole position. What's key in the next 2 months for the public to decide?
Yeah, it's remarkable that this is such a close, competitive election. There's really only 7 states and probably only tens of thousands of voters in those 7 states. that are going to end up deciding this election. And in each one of those 7 states, the campaign is in the margin of error of the polls. Interestingly, Harris is kind of doing all the normal things you'd expect out of a high-quality campaign. They're raising a lot of money. They're spending a lot of money. They're trying to turn out the vote. The Trump team is very focused on its immigration message, but also focused on preempting what they say is election fraud that they're anticipating. And, the U.S. runs really clean elections. Any objective observer knows that Trump lost in 2020 and is pretty confident that the election's going to be well run this cycle. But Trump's trying to confuse the issue, hoping to perhaps make it so that there are disputes over certain states' ballots that would deny Harris a 270 electoral college victory and kick the race over to the House of Representatives, where he will probably win.
Sounds messy. John, before we let you go, let's talk EU-China, because a short while ago we were talking about how the European Union and China are trying to avoid looming tariffs on Chinese EVs. Is this going to be a lot worse before it gets better, do you think?
Absolutely. And I think the EU theme is an interesting one, because what you're starting to see is a global backlash against the excess capacity that China's pumping out in the world because they're just not consuming enough at home. The EU's doing it. Brazil's doing it. It's happening. The US is, of course, doing it. It's happening all over the world. And that's yet another challenge that China's going to have to manage in the coming years.
Are you seeing any policies come out of China that gives us insights into how they feel about that? Because they are now slightly getting ostracized by a number of regions. It's not just the United States.
I think the Chinese are trying to figure out kind of where they fit in the world here, and how I think that they're probably a little taken back by the backlash that they're experiencing. And, in terms of the U.S., they kind of have to wait and see what happens after the election. If Harris wins, they know the players on the field. There will probably be a little bit of change in terms of the Biden to Harris cabinet. But if Trump wins, you're going to get a radically different group that the Chinese don't necessarily trust, and who they think the Americans in the Trump administration have it out for them.
Very quickly, John, 20 seconds or so, in terms of China-Russia, do you see this relationship shifting in the new year?
Probably not. China's been pretty supportive of Russia in terms of dual-use goods that the Russians have been using, and another kind of vector of risk for the U.S. has been the Chinese relationship with Iran, where they continue to buy Iranian oil. That could change in a Trump administration.
All right, John, thanks very much for taking out the time to come into our studios. We do appreciate it. John Lieber, Managing Director of Eurasia Group's U.S. practice, chatting here about U.S.-China relations primarily, and a little on the U.S. elections, which are fast arriving.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.